Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to your U.S. Markets Update. And it's a good update if you're stateside because stocks rose on Thursday as traders anticipated that the latest reading of a key consumer inflation gauge won't stand in the way of the Fed lowering its benchmark interest rate next week. The blue chip Dow finished up 617 points or 1.36% to close at 46,108. While the broad market S&P 500 ended up 0.85% at 6,587. The Nasdaq Composite, meanwhile, advanced 0.7% to close at 22,043. All three major averages scored new intraday all-time highs in the trading day and closed at record levels yet again. It was a confusing batch of numbers with the CPI reading for August coming in hotter than expected on a monthly basis, but in line with expectations on an annual basis. So CPI showed an increase of 0.4% for the month, higher than the 0.3% that economists polled by Dow Jones were expecting. But the index recorded 2.9% on a 12-month basis as expected. To see how markets reacted to all of this news, we have on the line now David Abella, Director of Investments at GoalVest. David, how are you doing?
Great to be here. Thanks.
Yeah, thanks for coming on. The market's looking pretty hot at the moment. Is this the best September you've seen in some years?
Yeah, it really is. And it's been a bit of a surprise because we had that really tough April with the initial tariff announcement. It's been a strong market for the last few months, and then this month has continued August strength, and it's been a bit surprising. I would call it, I've used this term before, but climbing a wall of worry. But the market does seem unstoppable at this point.
It does. And on Wednesday, let's look at the big data release from the last couple of days. There was an unexpected decline in wholesale prices, which boosted investor sentiment. And then on Thursday, CPI numbers came out. Now, it was a bit of a confusing batch because the reading for August came in better than expected on a monthly basis, but they were also in line with expectations on an annual basis. Can you explain how that panned out?
Yeah, so as you mentioned, the annual basis came in 2.9 headline, and that was okay. But it was 0.4 on the monthly basis, which was higher. I would caution that if it stays like that over the next few months, it'll start to become a problem. But the market thought that it could be worse, and it wasn't enough to derail the Fed, so they looked through it. But the U.S. is stuck at kind of like a almost 3% inflation level, and if that were to go up from there, U.S. markets could get a little choppier.
Yeah, we saw yields also falling in the wake of the data releases. I think the yield on the benchmark 10-year Treasury dropped to 4%. We also had some news coming out of the labor market, which received another sign that it's slowing down. Weekly jobless claims seeing a surprise jump after job growth figures were revised down earlier this week. So we had workers filing for unemployment compensation for the week ending September the 6th, increased 27,000 from the previous period to a seasonally adjusted 263,000. That's the highest level since October 2021. Any cause for concern, more so than we saw earlier this week?
Well, right now the market likes it. It's a bit of a Goldilocks as being not too hot, not too cold. So if that's another area where if that continues to increase, then it might be, okay, is the U.S. starting to enter a recession or maybe it's more like stagflation. But having said that, right now it's not viewed as with concern, and because the overall unemployment rate at 4.2, 4.3 is still very low by historical standards.
Yeah, I think Wells Fargo also made a good point. They said that history has shown that in the past decades, even in very good economic times, the initial jobless claims would frequently come in at levels above 300,000. So companies are not hiring, but they're not firing either. So I guess that's a good omen.
That's right.
Let's look ahead now to the next FOMC meeting, David, next week. Now that the Fed has all the data it needs, are we looking at that 25 basis point cut?
Yes, here at GoalVest, we do think it'll be a 25 basis point cut, and that is the kind of the overall consensus. There is some level of probability of a 50 basis point cut. We feel that would be too much, and the market actually could react negatively to that. It could cause concern that the Fed is concerned about the economy slowing down too fast. But I think 25 is really the perfect number. It makes sense. That's what the market expects. I'd be surprised to see anything else. I think it'll be well received and help the markets continue the positive trend.
Do you see there being 2 further cuts at the remaining 2 meetings after the one next week?
Yeah, every model that we've looked at and other analysts we've talked to seem to think that it starts to become a self-fulfilling prophecy. So that does seem like there will be 2 more cuts. But on the other hand, if that CPI number starts to pop a little bit and it gets into like a 3-something headline, that might derail it. But if it stays at like 2.9 or 0.4 on month over month, I think there's probably 2 more cuts.
Yeah, a big driver of market growth stateside is also solid earnings growth, and we saw that with Q2 earnings. So what are we looking at expectations-wise for Q3?
Yeah, so that's really the biggest driver. I mean, there's definitely some companies that have been missing, but in aggregate, earnings last quarter was 7.5%, and it's expected to be about the same in the third quarter, just a tick lower, 7.2%. So that's now an important kind of benchmark for these companies to hit. But the earnings have been great so far in 2025.
Yeah, mostly driven by big tech. But do you see a rotation by investors out of large cap industries, large cap stocks, I beg your pardon, into small cap?
Well, the small cap had a great August. Actually, most small cap indices were down year to date, and then August kind of pulled them positive. And it's continued into September. Having said that, we kind of like a barbell approach. On the riskier end, we do like tech. There's just as an example, is the Spider Technology ETF, and that ETF is up through today a remarkable 27.5%. And one interesting note about that ETF: only 2 of the top 10 names are Mag 7. So it really is growth of tech in general, and not just those 7 names.
Yeah, not just those 7 names. Indeed, there's also not been much talk of tariffs lately. Are those Q3 earnings going to take into account the impact of Donald Trump's tariffs?
Yeah, that's a great question. So one thing about tech is mostly immune from tariffs. That's especially true with the service and software companies. But you are seeing, say, retail or certain consumer companies that are trading at basically 52-week lows, the exact opposite of kind of how the market is. And a lot of it is because of tariffs. You're seeing even in the U.S. food companies, and maybe they have to import steel for their cans, and a name like Campbell's Soup or something, and it's trading at a 52-week low. I guess a bit off the low. But yeah, it definitely, there's winners and losers right now in the U.S. market. And if you're too kind of hit by tariffs, you're unfortunately a loser.
Okay, so tech's still a safe bet for investors. Where else do you think they should be positioning themselves in the current environment?
The dividend stocks, which are traditionally better value and safer, they, generally speaking, dividend stocks do well in a downward interest rate environment. So you can collect the attractive yield and you get a little bit of a tailwind with the lower interest rate. Those are generally more conservative stocks. They're not going to have like 27.5% year-to-date performance, but on the other hand, they balance and they kind of reduce risk of a portfolio.
And what's your take on precious metals? Is that a good place to be as well?
Yes, we like gold as well, and we have an allocation to it, and that's really like insurance in the event that the deficit or the dollar deficits get too high, the dollar gets too weak, maybe the tariffs start to really have an accumulating effect that's negative, and just a store of value that we think can hold despite what the underlying markets are doing.
All right, tech with diversification, dividend stocks, and gold are the places to be for investors right now. And we've been in conversation with David Abella, Director of Investments at GoalVest. David, it's been a pleasure having you on the show, and have a fantastic evening.
Thank you. You too as well.
All right, take care. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.